Welcome to the deep dive. You brought us a question that's definitely buzzing right now. With these recent moves from China's central bank, are we finally looking at a potential bull run in the Chinese stock market?
hmm
And you shared some great source material pointing to specific actions, lowering reserve requirements, that's and gens them, and cutting interest rates.
Yeah, these are definitely significant tools they're pulling out of the toolkit again.
So, our mission here in this deep dive is really to peel back the layers on this. What exactly are these policies? What do the sources you sent actually say about how they've impacted the market historically?
Right.
And, what might it all signal for the Chinese market now? Is this the start of something really big, or is it maybe just another short-term bounce? We're going to try and unpack all that based on the material you provided.
Exactly. We'll look at the mechanics, the history, the data from the sources, and what it might mean for investors. Yeah, keeping it grounded in that analysis.
Okay, great. Let's dive in then. First things first. Are you and Xi'an basically the same thing? I mean, it sounds like they both aim to boost the economy, right? But are the ways they work different?
That's a really good place to start. And no, they're not identical, although you're absolutely right. They share that common goal, stimulating activity. They just come at it from slightly different angles.
Okay, so walk us through rain first. The lowering of the reserve requirement ratio. How does that actually work?
Okay, think about it like this. Banks take in deposits, right? Money from people and businesses. The central bank makes them keep a certain percentage of that money parked with them at the central bank itself. It's like a safety cushion.
A reserve makes sense.
Exactly. So when the central bank lowers this ratio, this percentage, they're essentially saying to the banks, okay, you don't need to keep quite as much locked away with us anymore.
So it frees up money the banks technically already had, but just couldn't use.
Precisely. That cash that was previously held in reserve suddenly becomes available. Banks can then, theoretically, lend that money out. And your sources highlight that this is often aimed specifically at getting loans flowing, particularly to small and medium-sized businesses that might need credit.
Got it. So the main target for sure seems to be the banking system itself, freeing up their capital so they can push more loans out to businesses, hoping to stimulate the real economy.
That's the core idea. Boost the supply of credit where it's needed for business activity.
Okay. Now, switching gears then to lowering interest rates. How's that different?
So Shore works more on the price of money, and its impact tends to be felt more directly by individuals, by households. The central bank cuts its benchmark interest rates.
The main rates, everyone else follows.
Yeah, exactly. And those cuts then tend to trickle down and influence all sorts of other rates, the interest you get on your bank deposits, what you pay on mortgages, car loans, personal loans, even the rates big companies pay to borrow.
And I guess lower rates on deposits make just letting your money sit in the bank less appealing.
That's a key part of it. If the return you get for just saving is lower, you might start thinking, well, what else could I do with this money? The goal here is to nudge individuals to move money out of those static bank deposits.
And do what with it? Spend it. Invest it.
Both, ideally. Either spend it on goods and services, which boosts consumption, or invest it, maybe putting it into the stock market, which could help lift asset prices and overall liquidity.
Okay, so if RING is about freeing up banks to lend more to businesses, RIN is more about encouraging individuals to spend or invest rather than just save.
That sums it up pretty well, yeah. One tackles the supply side of credit for businesses. The other tries to boost demand and maybe shift household behavior towards, well, putting money to work.
But ultimately, they're both trying to achieve the same thing. Inject liquidity, get things moving, give the economy and maybe the markets a bit of a push.
Fundamentally, yes. They're both major levers in the central bank's toolkit for loosening financial conditions when they think the economy needs support.
Right. Now, let's look at the history here. Based on the sources you sent, this isn't exactly a new thing for China, is it, using these tools?
Oh, far from it. The sources really emphasize this. These measures, especially you, have been used pretty frequently over the last few years. I mean, look at the numbers mentioned. You happened 4 times back in 2018, 3 times in 2019, another 3 in 2020, 2 times in 2023, and now this latest one in 2025.
Wow, that is quite often. And the amounts involved sound enormous, too.
They really are. The sources mention that each tripture typically pumps at least 1 trillion RMB into the banking system. Some of the past ones were apparently even bigger, releasing up to maybe 4 trillion or nearly 2 trillion RMB. This most recent one is estimated around 1 trillion. We're talking huge injections of cash.
Okay, so here's something that kind of jumps out at me. based on the perspective in the source material. If they keep having to pump trillions into the system this often, why? Why the constant need for stimulus? Shouldn't the economy, eventually get going on its own?
That's a really crucial point this source digs into. The fact that they need to resort to such significant stimulus so repeatedly,
Hmm.
well, it suggests that the underlying Chinese economy isn't exactly firing on all cylinders with self-sustaining growth.
Hmm.
The source describes it as facing ongoing challenges, sometimes using terms like being in a state of involution or maybe just languishing, needing this continuous support just to maintain momentum.
So the very frequency of the stimulus, according to this particular view, might actually be less a sign of an imminent boom and more a signal of maybe some underlying weakness or struggle.
That's certainly the interpretation that the source leans towards. The argument is if the economic engine was really roaring, they probably wouldn't need to keep pouring this much fuel in this often.
Interesting perspective. Okay, let's pivot then to the market impact. With all this stimulus happening over the years, what does the data actually show about how the Chinese stock market has reacted? Specifically looking at the Husu 300 index, which the source uses as a proxy.
Yeah, this is where it gets quite interesting looking at the data provided. They analyzed 6 recent instances of ISWO, shown in the chart you shared, starting from 2021, and tracked what the Husu 300 did right after.
And what did they find?
The finding was pretty striking. Out of those 6 times, 5 times the index saw a noticeable upward move, or at least a short-term rebound, following the RU announcement.
5 out of 6. So based on that specific recent history, the market bounced more often than not after one of these moves.
That's what the data showed. Only one instance, back in September 2023, didn't see a positive short-term reaction. The market actually went down soon after.
Okay, so if we use that analogy you sometimes mention, like flipping a coin, if the last 6 flips landed heads 5 times, purely based on that history, the odds would seem to heavily favor heads on the next flip. So applying that here, this recent stimulus package, the He and red together, suggests what? A high probability of a positive short-term reaction in the Chinese market, just based on that historical pattern.
That's the conclusion the source draws from looking at this specific precedent, yes. A high probability of at least a short-term positive move.
All right, so let's say someone is looking at this historical probability and thinking, okay, maybe there's a short-term trade here. How might an investor, according to the strategies discussed in the source, actually approach that?
Well, the source suggests that for investors who aren't in mainland China, say if you're in Taiwan or somewhere else, a pretty common and relatively straightforward way is to look at related China stock ETFs that trade on your local exchange.
Okay, exchange-traded funds, what kind of ETFs are we talking about?
You've got your basic ones, the standard index trackers that just try to mirror something like the Husu 300. Then there are inverse ETFs if you wanted to bet on the market going down. And then you have the leveraged ETFs.
Ah, yeah, the 2X leverage ones, those sound a bit spicy.
They definitely are. I mean, they offer the potential for amplified gains if you're right. But, and this is really crucial, they amplify losses just as much, if not more, if you're wrong. The risk is significantly higher.
Right. Need to understand that leverage cuts both ways.
Absolutely. And the sources also make an interesting point that even if an ETF is called, say, Husu 300 leveraged, sometimes what they actually track under the hood are A50 futures positions. So you're getting leveraged exposure that way. The Yuanta Husu 300 leveraged 00637L is given as an example.
Good detail to know. Definitely pays to understand exactly what you're buying. Now, what about timing? For someone trying to decide when to potentially get in or out, does the source offer any technical signals they watch?
Yes. The source gets into using technical analysis to try and gauge the market's real strength and confirm potential turning points. One approach they mentioned, particularly for investors who want a bit more confirmation before jumping in,
The more cautious approach.
kind of, yeah, is to wait for the price on the chart to actually clear some key hurdles, specifically breaking above certain moving averages.
Moving averages. Like the average price over the last month or last quarter.
Exactly. So first, seeing the price move decisively above the monthly moving average,
Yeah.
sometimes they look for a pattern like 3 positive bars above it. That can be an early signal that a short-term upward trend might be gaining some traction.
Okay.
But for signs of a potentially more significant, maybe even a long-term trend reversal, the source suggests you'd want to see the price break clearly above the quarterly moving average. Breaking that longer-term average is seen as stronger confirmation.
So basically waiting for the market itself to show some real strength by pushing past these recent average price levels. What if someone's worried about missing the initial move? wants to get in earlier.
Yeah, for those who maybe have less conviction but a higher appetite for risk or just fear missing out on the first leg up, the source says you can consider entering earlier. But, and this is stressed, setting a stop loss is absolutely critical if you do that.
Your escape hatch if the trade goes south.
Precisely. You need a predefined point where you say, okay, I was wrong, I'm out, to limit potential losses.
And does the source suggest where a logical place to set that stop loss might be?
It points to looking at the low point of a previous significant price drop that happened on high trading volume. They describe this level as kind of the last defense of the bulls.
The point where buyers last stepped in really strongly.
Exactly. The thinking is, if the market breaks below that level where strong buying previously emerged, it suggests those buyers couldn't hold the line this time, and the attempt to form a bottom might have failed.
That makes intuitive sense. If the last strong support level breaks, that's probably not a good sign. So volume itself seems pretty important in this analysis, beyond just finding stop-loss points.
Oh, massively important, according to the source's technical approach. Volume is seen as the fuel, the energy behind a price move. They specifically look for increasing sustained volume as the price rises. They call it rolling volume.
Rolling volume.
Yeah, that's a key signal that a rally is genuine, that it has broad participation and momentum behind it. You know that old trading saying, price needs volume to confirm a real move higher?
Right. So conversely, what does it mean if volume starts to dry up?
Well, if you see the price going up, maybe even quite sharply, but the trading volume starts to contract or shrink afterwards, the source views that as a warning sign. It suggests the buying power isn't really there to sustain the move.
Like the rally is running out of steam?
Exactly. They use this analogy, no large fish in shallow water. Without that growing participation, that increasing volume, the rally is probably fragile and likely to fizzle out. It might even signal a potential short-term top or a good place to consider taking profits.
And the source actually used that specific leveraged ETF, the Yuantapusan 00000637L, from late 2023, early 2024, as an example to illustrate these volume points, didn't it?
Yes, it's a really vivid case study from the material provided. That ETF went on a tear, more than doubling in value pretty quickly from around 12.5 up to 24.
Wow.
And crucially, during that big rally, the trading volume was consistently increasing as the price climbed. It showed that classic rolling volume pattern, signaling real momentum.
Okay, so rising price, rising volume, healthy sign. What happened near the peak?
Right around the top, the source points out there was a day with absolutely massive trading volume. They called it super sky-high volume. A huge amount of shares changed hands. But then the critical part is what happened after that peak volume day.
Volume dropped off.
Sharply. As the price started to decline from the peak, the volume reportedly fell significantly, maybe by about half in the following days and weeks. So you had this combination, a huge volume spike right near the top, followed by shrinking volume as the price fell. To the source, that pattern screamed that the buying pressure had evaporated.
That's a clear example. So bringing that insight back to the current situation with the main Husu 300 index, what does the volume look like now, according to the source? Has it shown that kind of rolling volume?
Well, the source notes that right now, while we've seen this rebound, likely driven by the policy news, the volume on the overall Husu 300 index has not yet shown that significant sustained enlargement.
So no real rolling volume yet.
Not in the way they describe needing to see it for strong confirmation. So, based purely on their volume analysis framework, the lack of that strong increasing volume suggests that while this rebound is happening, its current strength might not be enough yet to signal a true, durable, technical, long-term trend reversal. It can still just be a bounce.
Okay, that adds a very important layer of nuance for timing and assessing the strength of the move. Now let's just zoom out for a second. We've talked about the historical odds of a short-term bounce. We've talked about technical signals. But the source also offers a pretty significant word of caution about the bigger long-term picture, right?
Yes, they definitely do. It's important context. While these policy actions have historically triggered short-term market pops, the source emphasizes that the underlying long-term trend for the Husu 300 index, well, despite all those stimulus efforts we talked about, has actually been downwards for quite some time.
Characterized by lower highs and lower lows on the chart.
Exactly. A classic downtrend pattern over a period of years, even with these intermittent policy boosts.
And this connects right back to the reason why they keep needing the stimulus in the first place, based on the source's view.
Absolutely. The source reiterates that this persistent long-term downward market trend is seen as reflecting those ongoing challenges and the relative contraction, that involution idea in the fundamental real Chinese economy.
Hmm.
The stock market can get temporary lifts from liquidity injections, sure, but ultimately its sustained direction has to be tied to the actual health and profitability of the businesses and the spending power of consumers it represents.
So, for a real sustained flying bull market, as they might say, to actually take off and last,
Yeah.
what does the source suggest really needs to happen?
It boils down to needing to see a genuine fundamental turnaround and visible improvement in the real economy itself, not just policy stimulus, but organic growth.
Tangible signs on the ground.
Yeah, the source uses a great down-to-earth example. You'd want to see tangible signs like five-star hotels and popular restaurants being consistently packed, needing long waits or advanced bookings. Things that show consumer confidence is truly back, businesses are thriving on their own, and economic activity is genuinely humming along, not just propped up by interventions.
That really clarifies the whole picture. Okay, so we have this dynamic. Central bank policies, like the recent and Ringu, have a historical track record, based on the source data, of often causing short-term market bounces. And the odds, based on recent history, seem decent for that happening again now.
Right, the short-term probability looks favorable based on that pattern.
But the persistent need for that stimulus in the first place, coupled with the long-term downward trend of the market itself, tells a different story about the underlying economic fundamentals. They still seem to face significant challenges, according to the source, and those fundamentals are ultimately what's needed for any sustained bull market.
Exactly, it's that classic tension, isn't it? Liquidity-driven rallies versus fundamentals-driven trends.
Yeah.
And it seems both forces are really at play here in the Chinese market right now.
This has been a really fantastic deep dive, thank you. We've unpacked Hu and Ray, looked at that compelling historical data on market reactions from your sources, explored some of the technical and volume signals they use for timing, and crucially, placed it all within that broader context of the long-term economic picture they describe.
And understanding that bigger picture, that context, is just so vital when you're trying to make sense of these short-term market moves.
Absolutely. So it leaves us and you, the listener, with this key tension to think about. Given this history of policy often leading to short-term pops versus this persistent, challenging, long-term economic backdrop that keeps requiring that stimulus, how will you interpret the next market moves in China? What indicators, maybe beyond just the central bank announcements, might you start watching to try and gauge the true health of the real economy, the kind of health that could finally support a truly lasting upward trend?
Definitely something to keep a close eye on as this whole story continues to unfold.